Hi, everyone. Welcome to the TimingResearch.com Crowd Forecast News, episode number 279 for October 26, 2020. My name is David Kosmeter. I'm the creator of TimingResearch.com. And today you're going to be hearing from the option professor. You should be seeing his screen right now. And he's going to be talking about what he's seeing in the markets right now. So I'm going to go ahead and turn it over to him.
Okay, thanks a lot, David, and welcome everybody. Good to have you with us here this morning on a Monday morning. It's quite a red morning out there. Just a little background on myself. I've graduated of Boston College, and I went to graduate school over at the University of California, Los Angeles, and I've been in the investment arena for many, many decades. I've done option seminars throughout the nation and in Canada, and have educated thousands upon thousands of people on how options work. So I'm pretty familiar with everything from options to stocks to commodities to municipal bonds to the whole 9 yards of what you can do with your money. So I do have I'll just briefly say it now, but I'll talk about it at the end. I have a weekly market update that is free of charge at optionprofessor.com. And I think we've been very, very accurate on things like the stock market and the bond market and things such as the crude oil, natural gas, the US dollar, gold, silver, copper, Bitcoin, as well as things such as soybean, sugar, coffee, cocoa, that kind of stuff. So, we have a very wide-ranging thing. But this week, our headline was the stock market, can you trust it? A big week ahead, read on. And I go out and outline that I was looking for a 5 to 10% correction in the next 2 to 8 weeks. I didn't know it was going to be the next 1 or 2 days, but obviously we're starting. So very much warned on this, and I outlined why, how things could get revalued with the steepening yield curve. And I also said that obviously the cases are rising quite a bit on the virus. And I also said that we have the election coming up, and we have a situation where it could be buy the rumor, sell the fact. Meaning what? Meaning everyone bought into the stock market, ran it up to 3,550 or whatever it topped out at recently. And so all the news that's coming out on the earnings have already been discounted. And that's why we've seen some stocks go into the tank even with good reports, or they really go in the tank when they got bad reports. So this is all outlined in the weekly newsletter. And I also talk about how to hedge. Again, I've been doing this for decades. So I know how to do covered calls and collars and married puts and replacement trades on how to reduce the risk in your portfolio and protect those gains. Very much know how to do that for many, 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 many years. So is it worthwhile to get a free update every week? Well, if you read this week's, you'll see it was very worthwhile because, again, you were quite warned that what is happening today was on the horizon. And again, I'm not bearish longer term because I do think stimulus, and I do think that the comparisons in the first and second quarter next year are going to be so low because of this year, quarter 1 and 2 was such a beaten down thing. Anybody's going to beat those quarters, right? And then, of course, you got all that sideline money, like 20 trillion bucks running around between corporate, private equity, corporate, private money. And again, they're going to get tired of zero in the interest rate market. And they're actually losing money in bonds now because rates are rising on bonds. So the bottom line is that the future is bright, but it is going to be a tough sailing, I think, between now and the end of the year, possibly. And again, while everybody's saying 3,900 by the end of the year, that's not going to happen unless we can take out 3,550, right? So the bottom line is right now, it's probably not a terrible time to play Missouri. You know what Missouri is? It's the show me state. Show me you can take out the highs. Show me you can keep the banking stocks up for more than a week. Show me you can get the value stuff to stay above its moving average for more than a week. And then maybe I'll play ball. But I'm not going to play ball catching a falling knife right here because this knife could go down quite a bit. I'm going to show you where right now. Okay, so let's go over to the 20-year graph. This is on the S&P 500. I'm going to show you the under indexes too. Now, again, here's the problem. You see this high point here? That comes in at 3,400, right? Right there, about 3,400. Okay, where's the RSI? The RSI is down here at 68. What about these highs here? You had highs there, and the RSI and high there, right? And the RSI was way up at 87. Then the RSI is going where? 77. And then the next high we just made, the RSI was at 69. And then we just made a brand new big high, and the RSI was at 65. That's called a divergence. And the reason that occurs is because the volume's drying up and the momentum is drying up, and ergo, the prices are drying up. And that's why 3,600 is going to be a rough racket to get through in the short run, unless we get a stimulus situation, a vaccine, a therapeutic, everybody goes back to work. These companies that are downsizing resize a bit, and we figure out what we're going to do with 12 million people who don't have a job, okay? Because if we don't figure out those things, we're not turning the corner, we're not doing anything like it's going to go away next week and the vaccine will be out by Friday. That talk is just not resonating after some point, because you can only say, around the corner, over the bend, and behind, my homework will be in next week, until the teacher says no mas. So the bottom line is if we get real resolutions on some of these things I just mentioned, then the trends are clearly up. So you don't want to be bearish in an uptrend. The only time this was ever violated since 2010 was during the crash we saw in March and April. And the Fed saw the same chart, and they knew that if this thing stays down here and these things roll over on a long-term graph, then we're not talking about a short-term blip. We're talking about everybody losing confidence. We're talking about people really sitting on their wallets, which, savings rates and cash on the sideline is still at record levels, because people are not stupid. Their houses are going up, so they feel richer. Their stocks had a bang to the upside, so they feel good. But they're not going to go out and do crazy purchasing when their jobs are at jeopardy, right? And so the thing is that there is a lot of real estate between where we are at 3,600, 3,400, right, and where the moving averages come in. And the moving averages come in at 3,105, 2,952, and 2,815. And again, getting above 2,800 really was when this thing told me that you got to get back in. Because once you got back above 2,800, then you could see that they had reinstigated the trend. That's why the Fed put in 44% of GDP to get this thing going. Do you know during the crash of 08, how much they put in? 5% of GDP. Do you understand the kind of stimulus that they're throwing at this thing? Unprecedented increase in the money supply, right? But they're not doing it, they'd like to cause inflation, but the only thing they're really trying to do is make sure that when you go to the money market account, it's there. If you bought a corporate bond, investment grade, that it's not 50 cents on the dollar. They wanted to see that your municipal bonds, because you loan money to the municipality or the state, isn't going at 50 cents on the dollar. That's why they printed all that money, because they wanted asset prices to go where? Back up. Now, they know if they put interest rates at zero in the bank and people have a 6% nut to crack, they can't get it in money markets. So what do? They got to put it into stocks, right? So that's basically what's gone on. And so what are we going through here? I think we're going through a period where you could see a correction. Why? Because Goldman Sachs, for one, cut fourth quarter GDP in half. So this fourth quarter is not supposed to be robust. So the news coming out in the fourth quarter may not be that great. When you're at 3,600 and you're 2 miles away from the moving averages, you can't afford to hear things aren't that great. You got to hear that things are going unbelievable. Now, when your valuations on the stock market have gone from on Apple from 20 to 30 or 40, then obviously, if interest rates go up at all, yields start rising because people figure, hey, listen, what am I doing here? I'm getting 1% on my money on this treasury bond going out 20 or 30 years. They don't owe me the money back for 20 or 30 years, and I'm getting a lousy 1%. Now, on top of that, what are they paying me back with? They're paying me back with $1 that's already lost this year alone, about 12% of value. What is it going to be in the next 20 years with this kind of printing? They don't know. And ergo, that leads people to sell out of those instruments. When they sell out of those instruments, obviously the prices drop and the yields rise. It's not happening dramatically, but on a percentage basis, it's pretty dramatic. And the spreads between the 5-year Treasury and the 30-year Treasury hit a high point since 2016. And on an actual yield basis, when we went down to 0.4% on the Treasury long-term in March, or the 10-year, at 0.4 or whatever, and now it's at 0.8, that's a 100% increase in yield since March. Now, I've been around for a long time, so I remember when Volcker pushed interest rates to 16% back in '82. My position is, as egregious as that high point in rates were, historic high point in rates. We may very well have seen a historic low point in rates in March. And you'll notice that the prices of bonds are nowhere near where they were in March. And anybody who had gains in March no longer have those gains anymore. Their equity is dropping on the actual principal as far as the value of the bonds. So if you're holding bonds since March, the value you had in March is nowhere to be found. You're losing value there. And then, of course, the stock market has had a pretty big run here. But again, I don't know if this is the start of something. Only time will tell. But it certainly looks like it's rolling over a bit. But that gives you an idea of where some of the lines in the sand could be if things start unwinding. Because when they unwind fast, like they're doing today, you want to have some goalposts. Otherwise, you're, the one-eyed man in the valley of the blind walking around into things. So here's some lines in the sand: 3105, 2950. And then 2800, 2815. Those would be three decent lines in the sand to keep an eye on. All right, let's go a little shorter term, 5 year. And again, you're still looking at the blue line here at 3131. And you're looking at 3368. So it's coming down to test the 1 year. Right there. Let's see what you got. Yeah. So it's coming down and testing that. Let's see if it can bounce. That would be an area, obviously, when we're up here, you would say that that would be an area where it could bounce from. And today's low is 3371 and it's 3368. So there's a good reason why if you were a short-term trader or you wanted to see about a bounce, this would be the neighborhood. Then if we break here, the next ones down here are more in the 3100 range, which means what? 3131, 3150. You remember that 3100 area is kind of the longer term first level. So that's an area where, like I say, that would give you about a 10% correction, which I said in the newsletter, 5 or 10% correction off the highs. So from 3,500 and change, 5% takes you down here and a 10% takes you down where these lines are. Okay. 3,200, maybe they'll try to take that out. You know how many people have their stops underneath there? Probably everybody. So if they can take it a little bit under 3,200, everyone who's got a stop loss, meaning a sell, they'll get kicked out. Who do you think will be buying? Market makers, smart money maybe, right? And they'd be buying down here to all the volume that's right under 3,200. Then maybe it stops. And then, of course, if they announce a stimulus and then the vaccine news comes out and then people start thinking about quarter number 1 of 2021, then that's how you could make it go back up. Again, it's good that all these three have crossed. There's nothing wrong with that. That's positive. But again, let's look at the RSI. And as you can see, where's the high point here? The high point here is around 3,400. Where's the RSI when we hit that high point? It looks like it's right in the area of 73, 72. Where is it on this big new high? It's at 62. That's a divergence. That's a divergence. And then we tried to make another new high here, and then we only went back to 62. And here we were at 60. Yeah, we're all about the same. So again, this stuff up here, could be somewhat dangerous because, again, how many people are talking 2,800, 2,850, 2,900, 3,000 on the S&P? How many people? None, not many. So that means we're pretty crowded. On the what? On the we're going to 3,900. Oh, we're going to 4,100. Oh, we're going to 4,200. Okay? When everybody's crowded, you got to put something on going the other way, be it an insurance put, be it some type of a collar. I mean, if you don't think it's getting above 3,600 for a while, you sell calls above 3,600, not on this, but maybe on a stock. And then you take that premium and you buy some puts underneath. Why? Because if the market starts really going down and everyone else is, panicking, you'll have at least some insurance on there that will allow you to do what? Protect your principal, which obviously was in the tank and has come back to life. But now, again, this is the tech rally because of so much heavy participation in the S&P is with Facebook, Google, Apple, and Microsoft, right? So again, these things had big runs because we went to the digital world, right? And everybody's buying online and they're shipping stuff to them and they can't go out to, shows and they can't go on vacation. So instead of that, they're buying things like houses and they're buying things to fix up their houses like Whirlpool washers and dryers, and they got $1,200 in the mail, so they went and bought a new refrigerator, whatever. And again, that was all pulling forward of demand, meaning you can only buy so many refrigerators and washers and dryers, right? And if they've already bought them, then the quarter 4 is going to be a little slower. And that could also mean holiday sales would be slower. Used cars have gone nuts, and cars have gone nuts. I saw one Volkswagen agency, they'll let you buy a car, make no payments at no interest, and you can pay them over 2 years with no interest. So I mean, shall we say, shenanigans with financing of cars is off the charts. I'm sure housing is going to be off the charts too, as everybody's refining because you're at 2.8% on the mortgages, and they're probably yanking money out. So we know what that leads to. First time the housing pulls back, then everybody's got these mortgages again, and if they spent the money that they took out, you're back to square one with the same kind of nonsense that was the trouble the last time. At any rate, definitely still see a bull market going, but in the short run, as I mentioned in the weekly update, there is some danger here. Will it stop here? Well, right now, so far it has, okay? But if we get another leg down, what would give us another leg down? Say on Thursday, which is when the big boy, and this week is full of news. So these people are going to be announcing, these companies are going to be announcing earnings. If they announce earnings are fabulous, then let's see how they do. Because people are going to start looking at Q4, which again, many companies, including Goldman Sachs, have slashed their GDP forecast. They're going to start looking at the stubbornness of the unemployment rate. They are going to be looking at a new situation, either Trump 2.0 or Biden 1.0. Either way, it's going to be a little bit of a shakeup. We got healthcare, who knows what's going on with that. We got an infrastructure bill that has never come in this administration, but may come next. So we've got a lot of things up in the air here. And again, these cases are going way up. My hope and I think because of therapeutics and the vaccine, the death rate is going to be much less. And so after this initial shock about how cases are jumping, if it looks like most people are coming out the other side okay, and we can start calling this more like the flu than the plague of 1918, that's going to help in the next period of time. So basically, that's the story there. Let me show you again. We're going back to the old stuff, which is what? If this market's going to get shaky, you go to tech and growth, and basically that's what they're doing today more than they're doing anything else. Let's see how the Nasdaq's doing here. Hold on. I might as well just use the Qs. You guys trade the Qs. Let's use the Qs. And I'll show you on the same way. I like to look at different time frames. Okay, I like to look at different time frames. Now you can see the Qs are holding up much better than some of the other ones, but they still have the same similar pattern here. Again, they've got a high up here with the RSI. Well, they had a high here with the RSI way up at 80. Then they have a big high up here with the RSI at 69. That's a divergence. And divergence obviously, doesn't happen right away. In other words, it was diverging here and here and here and here, and then it stopped. Now it comes back down to 260. Then it tries to rally. You notice it failed to get above the high. And right now, the first line in the sand is 276. Today's low is 279. So you're in the neighborhood where it could stop. But the more important longer-term stuff seems to be what? Seems to be 254 and 239. 239 comes in right around the former highs. Sometimes the market will come back and test the former highs before it takes off again. Look at this. You had double highs over here, and then you have a what? A pullback. That's a big pullback, but it pulled back to the former highs. And then at that point, what did it do? It jammed out of here. Okay. Then this is the March crash. Okay. And then you go what? You're on the way up. Okay. But again, is there some danger up here? I think so. Why? Because again, a lot of the good news is in the market, and a lot of the news you're going to hear on earnings is already factored into the prices. Possibly. Again, when you're up here and you have this stuff, this is when you do trimming. And this is where you do hedging. Hedging can be covered call riding to bring some cash in, which is what I've been talking about in the newsletter here all for the last 2 months. So basically, you sell calls into these fat companies like Netflix and all the rest of them. And basically, Apple was at 140, post split, 150 calls sold, 135 put bought, stock drops down to 120, 115, 110. You got a hedge on. But anyway, this is what it looks like on a 5-year basis. Let's go on a 6-month basis and see if there's anything there. Yeah, as you can see, on a 6-month basis, it's getting a little bit more dodgy because it's already broken underneath its moving averages here. 285, 279, we already took those out, it looks like, or close to it. Yeah, it's hanging on here, I guess. And 281. Yeah, so, it's getting underneath its averages, and there's a lot of real estate underneath. So that's why, and this thing is now under 50. So, this is not good stuff, really, if you're bullish. That's why, again, I'm planning on seeing some type of a correction. Hey, listen, I'm from the school of, if I'm looking for a correction and it happens, God bless me. If I don't get the correction and it starts taking out 290 or 295, I'm allowed to get back on the train. It's not like I'm not allowed to come back in. I don't mind buying higher than where I sold if, in fact, I'm on the right train. Would you rather pay $50 to be on the right train, or you want to hang into something that's the wrong train and see if you can get blown out a bit? I like to get on, I like to have the stuff going up when I'm in, right? Don't you like to have it going up when you're in? Okay. So, right, and I like to have these averages underneath the price. You see, when they're underneath the price, you can go get coffee, you can go play some tennis. You want to go over to Barbados for a couple of weeks, you can do that, okay? They get underneath the markets, right? They get underneath it, and then it's not as smooth sailing. That's the last 6 months. Let's go to give you a year. Let's see if this year will come up. Come on, Mr. Year. All right. All right. Same story in the last year. We had the big drop in March. You jump back in when it goes above 200 and you ride it and you ride it and you ride it and you ride it. Gets bumpy in September, right? That's maybe your warning sign. Then it pops back up. Can't take out the high. And now we're coming back down. Now, I don't know. It could hold, like I say, it could hold some of these moving averages, which is testing right now, and go right back up. If it does, you go back in. If it doesn't, then you got a lot of powder dry. You got some hedges on. And while everybody else is getting whacked, you've done something to protect your equity. Okay, so that's the NASDAQ, and that is the Qs, of course, and that is going to be the S&P. Let's see what else. The other things, tax rates may change if Biden gets in there, and the tax rates are going to affect these things that are high flyers. So you could see some selling between now and year end just because people want to lock in the tax rate now, which is, could be much lower. And if it's higher, next year, well, what would you do with the gains you have in some of these stocks? Let's see what some of the stocks that are, shall we say, COVID oriented, stay at home, work from home. See, they're going. See, they're still hanging in there because obviously the bet is growth and tech. So this stuff is still in the front because it looks like the cases are rising dramatically. And who knows when this vaccine therapeutics are coming. So people are going to, if they're going to hide out someplace, they're going to hide out in those kind of things. Let's see what the other ones are, like Teladoc. Teladoc, not so much. They obviously like Zoom because we're doing Zoom right here. That's what people are going to be doing, Zoom. So that's obviously, it's a part of the lexicon of America now. Zoom me, right? And what about Peloton? That's another one in the lexicon. Let's see what that's doing. Peloton's not getting well. So it looks like Zoom is the only one they really believe in as far as the ones that I watch here on the COVID. So Zoom's hanging in there, but again, when they raid the house, everybody goes downtown, it looks like, right? So they're raiding the house today, and it doesn't look like even the high flyers are very safe. Like I say, I was talking in the 140 here of the selling of the calls and the buying of the puts to protect your equity. You see, when anything gets this far away from the moving averages, I don't know when it's going to come back down, but going further away from the averages doesn't make them less overbought. It makes them more overbought, right? So in other words, if it looks like it's overdone here at 120, right? If it goes to 140, it's not less overdone, it's more overdone. And that's why, again, they say the trees don't grow to the sky, so you got to monitor these things. I'm sure if we look at a short-term graph, like a 1 month graph, you'll see that you got a sell signal, and you did. See, that's what you do. You look at the long-term graphs to give you an idea where the main highway is, I-95, the 405, wherever you happen to be. And then basically you go to the shorter-term stuff to see where the traffic is currently. So obviously the long-term on these stocks and the stock index is all I-95 north, 405 going north, right? But in the shorter run, you're getting some signals of what? Of a bit of a turn, which would make sense because these things are so far away from their long-term averages that it makes sense that they're going to have some what they call reversion to the mean. And that's what we're saying. And this occurs when you have a compression on valuations, a compression on profits and margins, and obviously, things that are very overbought. And then, of course, you may have a tax rate change. I mean, what the heck, why wouldn't you grab something off the table and pay 20% capital gains tax before it goes to 28% or whatever the heck the rates are going to be, right? So these are the things that you got to keep an eye on here, and this is some of the stuff that I'm looking at. I'm going to go around the horn here and give you a little bit more of what I'm looking at as far as the interest rates are concerned. So you get an idea. Some of you must have some savings or fixed income, so let's take a look at it. This is the long bond, and then I'll show you TLT. Okay. So on the long bond here, let's go back and give you a little bit of perspective, because then you'll get the idea why I'm saying we may have seen a historic low in interest rates. And you can see that's called a blow-off parabolic move. And this goes back all the way to 2001. If you went back to 20 years before that, these prices would be in the 50s. So since Volcker, we've gone from 50 on these prices all the way up to 195. Now you can see we are stopping right now at the first moving average. So if we were to get a bounce, a market correction, could this bounce a little bit short term? And the answer is yes. Because obviously people go into fixed income if they're selling out of stock, and that creates a bid for this thing. Plus, we've already had a pretty big drop. 195 down to 170 is a 25-point drop. So that's a big drop. And then, of course, if you're getting a situation where people are rotating out of stocks into fixed income, it could get a bounce out of here. But look, you're still pretty far away from the longer-term support. And so there could be some further activity on the downside here. Okay, let's look at the short-term graph here, 6 month, and you'll get a sell signal a while back. Yeah, this is a 6 month. You crossed over the red line here at 180, so that's your first sell signal. You crossed over the green at 178, there's your second sell signal, and the blue was telling you to get out around the same price, 178. So you got a decent sell signal on the red line up here. All right, and then you go back down like that. All right, let's look at TLT, because that's what people trade on this stuff. I'm going to go around the horn on some stuff that I'm looking at. Hopefully you'll be finding some things interesting that I'm looking at. All right. There's your Treasury TLT. And if you go back a year here, you'll get an idea what kind of blow off top this thing had. Up at 180 and change, and now it's trading at 160. Trying to turn up a little bit here. Again, there's some resistance here. If you get a situation where people get out of stocks, you could get a bounce on this thing. But it does look like there's still some wood to chop between the prices and the support, because look where the support's way down here. So it could get a bounce out of this 155 neighborhood, right? you know? In a market that's rolling over, you want to sell strength, not sell weakness. If you sell weakness, you can get a pop. Look, if you sold weakness here, then you got a big rally. If you sold the strength, then you're good. So if this thing is going to bounce off here, you might want to sell it at a higher price. Maybe, sometime closer to the end of the year. All right, so that was the fixed income. Let me show you in the stock market some of the stuff that I thought might be interesting. This is a dividend ETF from Vanguard, and the yield on it is over 3%. And again, it was trying. This is a classic example of why you want to wait for the breakout. You see, this is on a 20-year graph. Can you see all of the traffic here is just totally congested at around 80 to 85 here? So if it went above 85, and this RSI is hanging right on 50, now it's under 50. Now it's at 48, okay? So if this thing is going to go down because we have a double dip recession coming, which nobody's talking about, then, it's a situation where, this thing could come down again, and then we could go right back down here. And this is all value-oriented and dividend-paying type of companies that need a steepening yield curve, that need a what? They need a recovery in the economy, okay, a mainstream recovery. Okay, so again, classic case of this stuff pays a great yield. It's value. I'll give you another value here. It's another Vanguard deal. There's SPYV, that's another one. But value pays dividends, okay? And that's what people like. Value pays dividends. And a lot of the value on the small cap and the mid cap and all of that stuff, they pay 2.5 to 3.5% cash flow dividend, right? So that is something that is very interesting to people because it's interesting to people because they want to get some income on their money. So when these people come out of what? Come out of their sideline cash, they may want to get into something. First of all, they'd like to see that VIX under 20. If you notice, the VIX cannot get underneath 25, and now it's already soaring above 30. That's kind of telling you that there's still a lot of risk in the market. Now, this stuff here is interesting to me because who doesn't want to get cash flow on their money, right? And who doesn't want to get valuations at 14 to 1 PE rather than 7,000 to 1 PE? So this stuff is getting whacked here again because it's giving up because it has failed to maintain above the area. So you see, this is the neighborhood where they're all converging. If this thing starts trading 82, 85, then you're onto something because the RSI will turn up as well. But if this thing starts getting under 75 or this, then you're probably going to maybe even go down here for all we know. So that's why the value trade looks very, very interesting, but also a little premature. And that's why I'm not unhappy about getting into it after it breaks out versus holding on to it now and then finding out that the house is on fire. Show you another one here that some people look at, which is the SPYV, which is the spider on value, spider value. And this thing, 2.5 to 3% cash flow on dividends. Again, same setup though. If you looked at I'll show you the banks in a second, same story, okay? If this stuff can get going, then it hasn't even captured its 52-week high. Whereas you saw from the NASDAQ has not only hit the 52-week high, it's a mile past it, 5 miles past it. So that's what makes this stuff interesting. It is undervalued basis where everything else has already gone if we're going to have the turnaround that everybody's talking about. If we're going to 3,900 like these people say on the S&P or whatever, then you're going to have to more than likely see a recovery, and that's when these things will pop. So again, longer term, holding on to stuff that pays cash flow out in the form of dividends is not a bad thing. And then you could get principal appreciation as well. So this stuff is very, very interesting to me. Here's a bank ETF. I'll show you both the big ones and the, now this one is a Vanguard again. There's many, many ETFs out there. I'm just using this as an example. This would have your JP Morgans, your Goldman Sachs, your Bank of America, your Wells Fargo, all those kind of guys. All right, US Bank, whatever. Okay, you see it tried to get up here, right, up to the 65 neighborhood, and now it's giving up. So this is why it's important to be patient. Let it get above the averages, because when it's above the averages, as you can see, it can be a nice place to be. But if it can't get above there, and the RSI is right at 50, so if it's going down again, I think it's back under 50 at 46. If this thing is going to go slip sliding away, your money's better out of it in cash. Okay? So again, the value trade came up to the river, went near the water, and right now has turned away from the water. And so if you want to make good money on the upside, I think you're going to have to get above these averages. And once you do, and things get reignited, it could go on a long-term trend while you're getting 2.5%, 3.5% cash flow on your money. That to me is more interesting than hoping that Netflix can go to 2,000 and Zoom is going to go to $3,000 a share. All right. So anyway, I wanted to just show you the value situation, because that could come in handy if we're going to get a legitimate turn either later this year or into next year. Keep an eye on those. I think they're worthwhile. That's why when people say the epicenter stuff that has not, and the cyclicals, right, and financials, they're saying these could be the next ones to go, but they're still having trouble getting out of the box. But when they get out of the box, you can see there's potential, because just going back to the former highs is about a 15%, 20% jump from here, right? So that's pretty good upside, plus it pays a dividend. Not bad. But you're never going to get up to the highs if you can't take out the blue, green, and red lines. And especially when they start pointing down like this, not good. All right. Went to the bond market. I showed you that. As far as fixed income is concerned, our opinion is short-term corporates and limited-term municipals is a good place to hide out. You get a decent rate, and you're not in with duration, because duration does have risk to it, as anybody who's in it knows. U.S. dollar. Let's get over here real quick. The U.S. dollar had a big drop, and that's why, for a number of reasons, gold, silver, and stock market, and the euro all took off. Not hard to figure. I'll show you to you right now. Now let's look at the long-term picture on the dollar, if I could. Hang on. U.S. dollar index. Let's see. Okay. Yeah, you can see the U.S. dollar on this is a 20-year graph. It goes all the way back to 2001. The dollar can drop, okay? 2001 to 2008, it was tanking, okay? Now, it stabilized between 08 and 2013, 2014. Then it started to get a rise, right? And the reason it did is, you remember, Europe and Japan went to zero and negative interest rates, and we had interest rates. So do you have to be Phi Beta Kappa that people are going to go where they can get an interest rate? So they're not going to be interested in anything Japanese yen. They're not going to be interested in anything called the euro, because these guys have negative interest rates, right? So the bottom line is that people went into the dollar, but it peaked out at 105 in March and early this year, right? And then and that's probably March when we had the big collapse. And then boom, now it's right back underneath everything, and that's not good. So as long as the dollar index remains under 96, 98, it's still in a bear market. But it may get a little bit of a bid when people get nervous. And today it's above 93. So in fact, it looks like it this month it even went to 94. So anyway, that's the story on the US dollar. And again, if the dollar firms up, that's when you could get the correction in all this other stuff. And then when the dollar goes back in the tank, which we anticipate it will do in 2021, that's when the stuff can get back on the bicycle. Because a weaker dollar, sometimes can cause big run-ups. Do you know from 2002 and 2008, what did the stock market do? It went through the roof. And look what happened. Boom, the dollar was tanking the entire time. So a tanking dollar is good for stocks, apparently. Now, again, we had the crash of 08, and that's when people go into the dollar. But they only go into it temporarily, and then it's back into tough sledding. And then, of course, we had the big interest rate differential, and that's why it went up like that. All right, so we just established the dollar is turned over, but it could have a little bit of a bounce here for a while. But again, if it can't get above these numbers, the printing of money, the deficits that are going to run are dollar negative. Okay, let's talk about what would that do to the prices of things like gold. Gold's down $1 here today. Now, again, gold, similar to tech, has had a very big run up, but that high up there at 2100 is surrounded by lower highs, right? And we are still very far away from the moving averages, which come in at, this is on the long-term graphs, 1676, and the longer-term stuff is still in the 1400s. Okay, so there's a lot of real estate between here and there. I don't know if it's going to be able to get all the way down there, but things can change. And when they change, obviously, it could surprise you. So the bottom line is that the gold is hanging in there, consolidating, right? Probably waiting to see if the dollar index will break 90. If it breaks 90, it could probably fly. But if it breaks 93, 94, and goes up towards 98, that could instigate some selling. It is a crowded trade because every other ad is about a silver or gold coin. And it is also a very crowded trade because everybody is unanimously thinking it's going to 3,000 or 5,000 over time. It may do that because that's where the trends are looking, right? But even up here, you know, people thought it would never go down, and it did go down because it's so far away from its moving averages. At some point, it gravitates back towards them. I don't know if that's the case here. Now let's look what the RSI is doing here. RSI here. Yeah, not too much of a divergence here. If we had another run up and the RSI doesn't go back all the way up, that might be interesting. Let's look at it on a shorter term basis, 6 month. Yeah, 6 months, it's still on the defensive. Gave us the sell signal at 1960, right? The red one gave you a signal at 2000. So short term, now it got violated here, whereas after it's gotten under the blue, not too much violation. So again, right now, you've got the green lines coming in at 1909, 1911, 1924. We're trading 1903. If you can get back above, what, 1920, 1940, right? Then it might be something that's turning. RSI right now is at 46. So if you got above 1940, and then you got this RSI back above 50, call me up. It'd be interesting. Otherwise, be careful if it breaks under 1800, 1880, 1840. Because if it does that, then the RSI is going to start going into the red area, which is under 50. And these averages are going to be above the market and pointing down, and that's no bueno. So I think gold's pretty simple. Under 1880, 1840, you know, it's going to be rolling over to the downside. And if you can start closing above 1940, then something's occurring, and it might be worthwhile to look at the long side. Let me show you silver. Silver gold ratio was like way over 100. That was the time to buy silver, sell gold. Yeah, silver went from 10 bucks, 11 bucks, all the way up to 30, as you can see. Now, in the weekly update, we got very, very constructive on the break above 18. You see 18 here? It was a high point, high point, high point, and then the red line was getting taken out. And then, of course, once the break above 18 happened, it was time to get long. So 18 to 30 is a pretty good run. Now, again, once you start breaking the red line up here at around 27, and again, getting under 24 would be another key. But this thing here is kind of the same story. If you can get above 26, it might be interesting on the long side. And there's a lot of resistance, 26, 27. So getting above this neighborhood would open up the door. But if you start taking out 24 and 23, then you have to start looking at the longer term graphs, like the 5-year even. And you'll see, look at the real estate underneath. So right here, the short-term average comes in at around 25.37. Getting above that number would be good. But right now, if it starts fading underneath these other numbers, you know, the next stop down here, down at, well, it could come down to the breakout point around 20. That would be more interesting to me. But it's a wild market, you know, very, very volatile. It's in, you know, when you get a move like this, expect it to be wild swings. Right now it's at 24.32. So you can see, you know, for my cup of tea, getting it above 25.37 would be the first thing of any interest. There's a little bit of a gap up here. So this 26.27 neighborhood is the real resistance. And then, of course, the support might be as low as, like I say, 19 to 21. And, of course, that would correspond to the mining shares, which have also peaked. GDX, GDXJ, SIL, SILJ. Those are some of them that I keep an eye on. Freeport-McMoRan's another story. That one's been very good to us. But again, you know, everything can get hit if the markets come down. Freeport-McMoran. We've been onto this thing since it was single digits. You'll see why. This thing gave you a great buy signal at 10. But if you look at the longer term graphs, it's even better. But, you know, it goes down to $5 a share. You know, anything like this goes down to $5 a share, and they have silver, and they got gold, and they got copper, and you believe that there could be a turnaround, then you got to take a look at this stuff, because it's not going to stay at $5 if there's a turnaround, because copper is being used in the infrastructure, and China's using a ton of it. And so then the supplies got tight because of COVID. And the next thing you know, it's not at 5. It's down here. Now it's a little bit overbought up here, right? A little bit overbought. So I love the 14 level as a line in the sand. 13, 14, I think is a great line in the sand. The averages come in here right around 13 and 12. So if you could get a correction on this thing, longer term, I think this thing's got a lot of oomph. And you can see on the long-term graph, you know, it's breaking out, right? So there's your chart here on the long-term graph. The moving averages come in 11, 12, 13, right? And, you know, any kind of a pullback towards this high point here, which is around 13 or so, might be very interesting, because I think we'll take out 20 at some point in the future, because these averages look like they're turning on a long-term basis. They're flattening out here and they're turning up there. All right, one other thing is Bitcoin. Two vehicles I look at for Bitcoin. One is GBTC, and this thing doesn't go back all that far, so let's just go back 6 months, because it hadn't been around that long. I don't have a wallet or any of that other stuff. Maybe I should, but when I want to play Bitcoin, I use this thing here. And what are we looking at here? Got a nice buy signal here at about 11. Now it's hit 15. It could have pullbacks again, but if I look at the long-term graph, 5 years, it looks to me like there's a lot of upside here. Why? Because it's digital currency. The next generation, the millennials, they do everything on their phone. They do everything on the computer. They are digital. They don't want to meet anybody. They don't want to talk to anybody. They want to buy things online like Carvana. Why do you think Carvana's going so nuts? Because elderly people are buying cars from them? No. So the bottom line is it's a digital world we're in. It's a digital world ahead of us, and digital currency, with what they're doing to fiat money in Japan and Europe and the US, you don't have to be a long jumper to make the leap to find out that this stuff is not going to become less interesting, but more. Blockchain supposedly is a fairly secure platform. And so again, in the future, it could be a lot more reasonable to use Bitcoin and digital currency. That's why PayPal's involved. That's why Square's involved. That's why, you know, there's some people are talking about having credit cards come out in the digital currency. So again, it's kind of like buying a tech stock very, very early. It's going to be volatile. It's going to be crazy. It's going to be bouncy. But if you just bought it and held on to it, 5 years down the road, you might not be unhappy. And look at this. If it gets above 16 and 18, look at all that real estate up here. Same thing with the pot stocks. This is MJ. It's a ETF for a bunch of pot stocks. And as you can see, you know, if it can start getting above these numbers here, which come in at 12, 13, you know, and get these things to turn around a little bit, you know, this thing could have some potential on the upside. I'd like to see the RSI above 50, and I'd like to see the prices above 14. And if you saw that, it might be something to keep an eye on. All right, so there you go on that one. Crude oil. All right. Our view on crude oil is as simple as this. The market obviously hit a bottom when it went to minus 37. Now, it is in a downtrend right now on the longer term situation. Let's just see here. Now, let's look at the 20-year. Gives you a better idea. 20-year. Okay, so still in trouble. You know, it reminds me of the value stocks, right? They all went up to the water, and now they're turning away from the water. Right now, again, getting above the red line is your first line in the sand. So we need to see it start closing above 43. And then we needed to start closing above 55 or 52. Okay? but the RSI is remaining weak under 40. Right now, Libya's coming on with supplies, and the demand is supposed to be drying up a little bit, so that's why it's rotating back down. On a shorter term basis, I thought that it might hold this 30 area. You see down here, 30 area. Because if we go back a little bit further, you will notice that 30 area is some former high point here. You see this 32 area to 30 right here. So I didn't think it's going to get any worse than here if they tank it. Okay. But I'm thinking next year we're going to have demand because the economy's turned around. We're going to get jet fuel to come back online, and that's going to be helpful to this. But again, this is still going against the flow, but I think the flow will change by next year, which makes things like Chevron interesting and Kinder Morgan and things like that. And ConocoPhillips just made a big purchase, but again, this thing is still hanging in there, right? But again, it's still under the 50. And when you're bullish, it's above 50. So again, still early on the energy stocks. Again, sometimes it's better to buy at 80 on its way to 90 than it is to buy it at 70 on its way to 65. But you are getting well paid by these guys. They haven't cut their dividends yet on Chevron, so that's interesting right off the bat. So that gives, and then basically there is one other market here. Well, I'll give you two quickies if I can get them in before the cutoff point here. This is something that we had put in the newsletter months ago, back in March, and it's been a very good payer, but it may be also having some trouble up at this 11 mark. But you see here in the 868 area, okay, this is where we brought it to people's attention that it looked like it's going to happen because we had China ahead of us. And again, we thought that the demand might be good. So we thought the supply demand dynamic might be good. And of course, China has bought a ton of these grains. That's why wheat, corn, and soybeans have had a big run. Now, the problem is you're going higher with a lower RSI. So that makes us nervous up here because it's too far away from its moving averages, and it's a similar high point from 2018. So again, this neighborhood here, we'd have to see how it does. We would keep it on a short leash because, again, of the divergence on the what? On the RSI to the price. So we're keen on it down here, not so keen up here, okay? Could keep going. But this would be the place to consider what? The selling of the calls against your position, maybe, the collar where you sell a call by a put, or the replacement trade where you get out of your futures contract and replace it with a call spread or something like that. Last one here I'm going to show you is sugar. Maybe I can judge one more in too. This is one we said 1230 was a good time to get in. Let's take a look. Yeah, why did we say 1230 was a good time to get in? Because this is on a one-year basis. If you look at a 6-month basis, you can see that right here, well, the 50-day and the 200-day came in at 1230, which was right around here, I guess. Yeah, right around, well, no, actually, it was at 1230 right when it was underneath here. So down here, the moving averages had crossed. And so we thought down here at around 1230 in here was a good time because the 50 and the 200-day were merging. Obviously, it's been a great place. Now you're at a situation where you have a high point surrounded by lower highs, and you have a situation where it's up against the 2018 highs again. So again, it has pulled back to the first level. It might come back to as low as the 1350 to 1380 area if the whole markets go over. But on a longer term basis, looking at it on a 5-year, it looks like there is more potential. After a pullback, maybe, it looks like if it can take out 16, that it opens the door. So 16 is a big number. Takes out 16, you got a lot of real estate up here. Last one is coffee. A lot of supplies of coffee, but it was a good thing to have earlier in the year. But it's pulled back now, and now it's got to hold 100 or 105, or else that's all she wrote. It might do that. So this is a neighborhood where I'd be looking at it. Okay, so again, you can see on a 5-year graph, it's had a couple of runs to 135. Again, we thought under 100 was a great bargain. Once you got above the red line, that was a signal. Boom, you got a great buy. When it gets way away from the averages, it can pull back. And then right now on a 6-month basis, We'd like it to get above 108 and hold this neighborhood here. Gets above 108, it would be interesting to us and would open the door for maybe a rally. But again, the RSI is still under 50, so don't know if you can trust it. All right, we're coming up to the top of the hour, guys. I covered an awful lot of information because I guess I got a lot of information in my head. These were my opinions. These were my observations. Obviously, Option Professor has their own opinions and observations that we try to extend every week in the weekly market update. Definitely, I recommend you do check it out to get our opinion and our observations. And if you have questions, you can shoot us a question at optionprofessor@gmail.com. So right now, again, after the broadcast, go to option, O-P-T-I-O-N, professor, P-R-O-F-E-S-S-O-R.com. Sign up for the free weekly update. It'll come right into your box every week. And then you'll also get other information that I haven't been able to cover here today. Right now, I'm going to turn it back over to David at the top of the hour. I want to thank everybody for being here. If you have any friends or associates that are trading and would like to find out our viewpoint, then clearly just give them the website, optionprofessor.com, and let them sign up for the free weekly update, because I think there's quite a bit of value there. Okay, so tell your friends and neighbors. Thanks a lot, you guys, and good luck on your trading. And David, back to you.
All right. Thank you. Lots of good info today. So just a quick reminder for everyone, be sure to subscribe to Timing Research on YouTube and your favorite podcast directory or app. And you can also go to TimingResearch.com to get the archive of this episode as soon as I can get it posted, as well as any of the past shows and events. I just want to thank my guest again for today, the Option Professor at optionprofessor.com. Thanks, everyone.